I found the document in the National Archives on a Tuesday afternoon in 2018. It was a letter written by Senator Nelson Aldrich to a financier named Paul Warburg in October of 1910, and in it, Aldrich confirmed the date and location of a meeting that was about to take place on an island off the coast of Georgia. The meeting was secret. The guest list included representatives from J.P. Morgan and Company, Kuhn, Loeb and Company, the First National Bank of New York, and the National City Bank. They traveled separately to avoid suspicion. They used first names only. They were there to draft legislation that would restructure the entire American banking system, and they did it in a private club where no reporters, no elected officials outside their circle, and no members of the public could watch them work. When I pulled that letter, I realized I was holding proof of the origin story of the Federal Reserve System, and it did not match the story I'd been told in school. Before 1913, the United States operated without a central bank. That was not an accident. It was a deliberate choice made over and over again across more than a century. The country had tried central banking twice before. The first Bank of the United States was chartered in 1791 and expired in 1811. The Second Bank of the United States was chartered in 1816 and killed by Andrew Jackson in 1836. After that, for 77 years, the American economy ran without a lender of last resort, without a centralized authority that could expand or contract the money supply, without an institution that had the power to set interest rates for the entire nation. During those decades, banks were chartered by states, not by the federal government. If you wanted to open a bank in Ohio, you applied to the state of Ohio. If your bank failed, it failed locally, and the damage was contained. The system was decentralized by design. That decentralization meant that economic panics, when they happened, did not cascade uniformly across the entire country at the same speed. A bank run in Kansas did not automatically trigger a bank run in Pennsylvania. Credit would tighten in one region while remaining accessible in another. Farmers in the Midwest could still borrow even when railroads in the East could not. The system was messy, uneven, and resistant to centralized control, which is exactly why many Americans wanted it that way. They had watched European nations hand monetary authority to central banks, and they had watched those central banks serve the interests of governments and large financial institutions rather than the interests of farmers, small merchants, and working families. Americans in the 19th century were not naive about power. They understood that the institution with the authority to create money and control credit would be the most powerful institution in the country, and they did not trust that power in the hands of a small group of men in New York. But in 1907, something happened that changed the political landscape. A financial panic began in October when the Knickerbocker Trust Company in New York collapsed. The panic spread. Depositors rushed to withdraw their money from banks across the city. Stock prices fell, credit froze, and then J.P. Morgan, the financier, stepped in. He was not a government official. He held no elected office, but he had the personal wealth and the institutional connections to organize a private rescue. He gathered the presidents of the major New York banks in his library on East 36th Street, and he told them they would pool their resources to stop the panic. They did. The panic subsided, and in the aftermath, a narrative took hold. The narrative said that the 1907 panic proved the American banking system was broken, that it could not survive without a central authority to stabilize it, that the country needed an institution modeled on the central banks of Europe to prevent future crises. That narrative was not wrong about the fragility of the system. It was wrong about the solution, because the solution that was eventually implemented did not come from Congress, and it did not come from economists working in universities, and it did not come from the farmers and small business owners who had suffered most during the panic. It came from the same men who had caused the conditions that made the panic possible in the first place. The meeting on Jekyll Island in Georgia took place in November of 1910. It lasted 9 days. The men who attended represented about 1/4 of the world's wealth. Senator Aldrich was there as the political architect. Paul Warburg was there as the technical designer. Frank Vanderlip, president of National City Bank, was there. Henry Davison, a senior partner at J.P. Morgan, was there. They wrote the draft legislation for what would eventually become the Federal Reserve Act. They did not call it a central bank in the draft. They called it a reserve association. They structured it to look decentralized, with regional banks spread across the country, but the control mechanisms were centralized, in a board that would be dominated by figures from the New York financial community. The bill gave this new institution the power to issue currency, to set reserve requirements for member banks, to lend money to banks in distress, and to buy and sell government securities in open market operations. These powers sound technical. They are not. They are the powers to determine the supply of money in the economy, the cost of borrowing, and the flow of credit to every sector of American life. And the legislation was written in private by the very people who would benefit most from its passage. The bill drafted on Jekyll Island was introduced in Congress in 1913. It faced opposition from William Jennings Bryan, from agrarian populists in the South and West, and from progressives who understood exactly what was being constructed. But the bill had support from the Wilson administration, from the major newspapers, and from the institutional weight of the New York financial community. It passed the House on September 18, 1913. It passed the Senate on December 19, 1913. President Woodrow Wilson signed it into law on December 23, 1913. The Federal Reserve System was born. The United States now had a central bank for the third time in its history, but this time the charter did not expire, and this time the political will to dismantle it would never materialize again. What happened next unfolded slowly enough that most Americans did not notice the mechanism at work. The Federal Reserve began operations in 1914. In 1917, the United States entered World War I, and the Federal Reserve used its new powers to help finance the war by buying government bonds and expanding the money supply. Inflation followed. Prices doubled between 1915 and 1920. The cost of food, housing, clothing, and fuel rose faster than wages. A pound of butter that cost 36 cents in 1915 cost 70 cents in 1920. A dozen eggs went from 34 cents to 68 cents. Working families saw their purchasing power cut in half within 5 years, and the mechanism that made it possible was the Federal Reserve's ability to print money and lend it into existence without the constraints that had existed under the state-chartered banking system. After the war, the Federal Reserve contracted the money supply sharply. Credit dried up, prices collapsed. Farms across the Midwest went under because they could not service the debt they had taken on during the inflation. More than 500 banks failed in 1921 alone. Then the cycle repeated. The Federal Reserve expanded credit again in the 1920s, fueling stock market speculation and real estate bubbles. Then it contracted again in 1929, and the contraction helped trigger the Great Depression. The boom and bust cycle that Americans had experienced under the decentralized system did not disappear under the Federal Reserve. It intensified. The difference was that the new system centralized the power to create those cycles in a single institution, and that institution was not accountable to voters. By the 1940s, the Federal Reserve had become the mechanism through which the federal government could finance itself without raising taxes. During World War II, the Fed agreed to cap interest rates on government bonds at low levels, which meant the government could borrow as much as it wanted at artificially cheap rates. The cost of that borrowing was not paid by the government. It was paid by savers whose deposits lost value as inflation eroded purchasing power. A dollar in 1940 was worth 52 cents by 1950 when measured in real purchasing power. That transfer of wealth from savers to borrowers, from ordinary families to the federal government and the financial institutions that held government debt, was not accidental. It was the structural outcome of a system designed to prioritize the liquidity needs of large institutions over the stability needs of households. In 1951, the Federal Reserve and the Treasury Department signed an accord that formally ended the policy of capping interest rates, but the precedent had been set. The central bank was now understood to be a tool for managing government debt, for smoothing business cycles, for responding to financial crises, and for ensuring that credit continued to flow to the largest players in the economy. What it was not designed to do, and what it has never consistently done, is protect the purchasing power of the currency that working Americans use to save for the future. In 1971, President Richard Nixon severed the last link between the dollar and gold. The Federal Reserve was no longer constrained, even theoretically, by the need to back its currency with a tangible asset. The money supply could now expand without limit, and it did. The amount of currency in circulation has increased by more than 3,000% since 1971. Inflation over that same period has reduced the purchasing power of the dollar by more than 85%. A gallon of milk that cost $1.18 in 1971 costs $4.21 today. A new car that cost $3,500 in 1971 costs $48,000 today. A home that cost $25,000 in 1971 costs $350,000 today. Wages have not kept pace. The median household income in 1971, adjusted for inflation, was $60,000 in today's dollars. The median household income today is $74,000, an increase of 23% over 50 years. Meanwhile, the cost of housing has increased by 1,900%. The cost of college tuition has increased by 1,600%, and the cost of healthcare has increased by 900%. The gap between income and cost of living is the story of what the Federal Reserve made possible. It is not the whole story, but it is the foundation. The Federal Reserve still exists. It still operates in the same building on Constitution Avenue in Washington. It still holds meetings every 6 weeks where a small committee of appointed officials decides the cost of borrowing money for the entire American economy. Those officials are not elected. They serve 14-year terms. They cannot be removed by voters. The meetings are closed to the public. The transcripts are released 5 years later. The institution owns more than $8 trillion in assets, most of it government debt and mortgage-backed securities purchased with money it created. It has never been audited by an independent authority. When it makes a mistake, when it holds interest rates too low for too long, and fuels an asset bubble, or when it raises rates too fast and triggers a recession, there is no mechanism for accountability that ordinary people can access. They cannot vote the governors out. They cannot petition for a redress of grievances. They can only live with the consequences. And the men who met on Jekyll Island in 1910 knew that would be the case when they designed the system, because accountability was never the goal, control was the goal. They built an institution that could survive changes in political leadership, shifts in public opinion, and economic disasters of its own making, and they built it to last. It has.